Right, let's just dive straight into this explainer. We're looking at the invisible yet absolutely massive environmental footprint of commercial banks and why it actually matters to you directly. Today, we're zooming in on the SASB standards for commercial banks. We're going to examine the deep structural connection between ESG, environmental, social, and governance factors, and the world of commercial credit. It's like looking under the hood of the global financial system.
Here's the roadmap for what we'll cover today. Section 1, funding the climate crisis. Then, the boomerang of climate risk. Third, rethinking collateral with ESG. Fourth, measuring financed emissions. And finally, Section 5, accounting for the future.
So, kicking things off with Section 1, funding the climate crisis. We're talking about the hidden impact of commercial lending.
We're going to follow the money, literally from your savings account all the way to massive global projects. And we'll break down exactly how banks measure the very real financial risks of climate change. But first, let's shift our perspective a bit. I want you to ask yourself, where does a bank's true carbon footprint actually come from? I mean, if you're picturing a massive corporate headquarters, the electricity to keep the lights on or the energy powering thousands of ATMs, well, you're only looking at a tiny, tiny fraction of the picture. The real systemic impact, that happens out in the wider world. It stems directly from the huge infrastructure projects, the physical assets, and the industrial businesses the bank actually chooses to fund.
And that brings us to an absolutely crucial concept: financed emissions. The SASB standards define this as the greenhouse gas emissions associated with a bank's commercial lending activities to underlying entities, assets, and projects. Basically, because banks act as the middlemen of the financial world, they generate massive environmental and social externalities, some positive, some negative. Think about it: a $100 million loan to massively expand a major agricultural operation. By just extending that line of credit, the bank inherently ties itself to the resulting land use emissions and the resource consumption of that whole expansion. Simply by providing capital to a real estate developer or a factory, a bank is actively fueling the emissions of whatever that money builds or operates. So the true footprint? It's not at your local branch on the corner. It's at the smokestack they financed.
Moving on to Section 2, the boomerang of climate risk. This is all about how those externalities swing right back to the bank.
Now, what's really fascinating here is that funding high-emission entities isn't just bad for the planet. No, it acts exactly like a boomerang. It swings right back to threaten the bank itself. The SASB framework makes it super clear: borrowers with high emissions are incredibly vulnerable to global regulatory changes. And that vulnerability financially impacts the institution lending them the money. So we've got three major villains in our story when banks finance clients with huge carbon footprints. Those are credit risk, market risk, and reputational risk.
Let's look at the real-world dangers by comparing credit risk head-to-head with reputational risk. With credit risk, a borrower is suddenly exposed to, say, new stringent carbon taxes, changing fuel efficiency regulations, or just rapid technological shifts that make their legacy business model obsolete. Imagine a commercial borrower gets slapped with a massive new carbon tax mandate. Boom. Suddenly their operational costs skyrocket. Profit margins vanish, and they might entirely default on their loan. Just like that, an environmental policy turns into a direct, measurable credit default risk for the bank. On the flip side, we have reputational risk. This is the direct PR fallout and the loss of consumer trust from financing high-profile fossil fuel projects. I mean, consumers and institutional investors are increasingly looking under the microscope at where their capital goes. So that risk doesn't just stay isolated out there with the borrower. It boomerangs right back to the lender's balance sheet, potentially triggering a huge loss of clients and investor confidence.
Which brings us to Section 3, rethinking collateral with ESG, and how banks are changing the very definition of risk.
To protect themselves from this whole boomerang effect, immense investor and regulatory pressure is basically forcing banks to fundamentally rethink how they assess risk from the ground up. If you contrast the old way of doing things with the new ESG reality, you really see what's changing in the boardroom. A traditional assessment, well, that relies heavily on macroeconomic conditions, central bank policy, basic supply and demand. A very standard historical view. But an ESG integrated assessment requires a much, much wider lens. The bank has to actually evaluate their specific exposure to carbon-related assets, dig into physical risks, and model out future climate trends. For example, a bank definitely wouldn't want to fund a highly water-intensive factory in a region that climate models project will face severe prolonged droughts over the lifespan of that loan. It's a massive structural shift. They're going from simply asking, hey, is this borrower profitable today, to asking, can this asset even survive tomorrow's climate realities? So how do these ESG factors actually alter the nuts and bolts of a loan? Like, how does it change the underlying paperwork? Well, the SASB standards mandate that banks incorporate these environmental factors into calculating a few key things. First, the overall creditworthiness of a borrower. Second, the maturity or tenor of a loan. I mean, maybe a bank decides not to extend a 30-year credit line if the borrower's entire industry might literally not exist in 15 years because of green tech shifts. Third, the expected loss, which mathematically includes the probability of default. And fourth, the actual value of the posted collateral. Really think about that for a second. A bank actually has to calculate if a piece of physical collateral, like say a coastal manufacturing facility, is going to lose its market value due to rising sea levels, and they have to do that long before deciding on the expected loss of a loan. The physical environment is directly dictating the financial math.
Let's jump to Section 4, Measuring Financed Emissions. This is where we turn abstractions into hard data.
Now, you might be wondering, how on earth do banks actually track something as seemingly abstract as a borrower's carbon footprint? Well, there's a surprisingly rigorous methodology for it. Let's walk through the steps so you can see exactly how banks do the math to assign emissions to their specific loans. Step 1. They calculate the absolute gross financed emissions of the borrower. This is broken down into Scope 1, Scope 2, and, crucially, Scope 3 greenhouse gas emissions. Scope 3 is usually the trickiest to measure, but it's absolutely critical because it captures the vast majority of emissions up and down the borrower's entire value chain, even including how their end products are used by consumers. Step 2, the bank determines their gross financial exposure for each industry by asset class. Basically, how much money do they actually have on the line in that specific sector? And Step 3, they use an allocation method to figure out the bank's exact share of emissions relative to the size of their exposure. So if a bank provides 10% of a company's total capital, they are statistically taking ownership of 10% of that company's entire carbon footprint right on their own books.
When you look at the industry standard SASB framework that banks use to report this data, you really start to see how this becomes operational in the real world. Under the financed emissions topic, the framework demands precise, hard, quantitative metrics. We're talking absolute gross financed emissions broken down by scope, and gross exposure for each industry. And get this, the updated standards are actually effective for annual reporting periods starting on or after January 1st, 2027. This proves that reporting these environmental metrics, it's no longer just some vague corporate aspiration or a PR talking point. It's a strict, standardized accounting requirement, and commercial banks are going to be aggressively audited against it.
Finally, Section 5, Accounting for the Future. Let's look at why this all matters for the bottom line.
Let's bring this all together and look at the ultimate consequence for the global financial system. Why does this massive structural shift in commercial banking actually matter so much? Well, the SASB standards put it incredibly bluntly. They state commercial banks that fail to address these risks and opportunities could face diminished returns and reduced value for shareholders. That really hits the nail on the head. It proves that ESG integration is definitely not just a moral compass or some nice, feel-good PR initiative. It is a critical financial shield. It's literally protecting the bank's bottom line from the very real economic shocks of climate change, sweeping policy shifts, and highly volatile market transitions.
So, here's the final, provocative thought I want to leave you with. If ignoring ESG factors and miscalculating climate risk means diminished returns and reduced value for a massive commercial bank, well, what does that mean for the money sitting right now in your savings account? Because the funds you deposit, they don't just sit idly in a dusty vault somewhere. They're actively deployed by your bank out into the global economy. And they carry risks and returns that are fundamentally tied to the health of our environment. So the next time you log in and look at your bank balance, ask yourself, what exactly is my money financing today? And is that investment truly prepared for the climate realities of tomorrow?